Imagine waking up, checking your crypto wallet, and realizing half your net worth has evaporated overnight. That's not a horror story. That's what happened to millions of investors when Bitcoin crashed. People panic sold, exchanges froze, social media exploded with conspiracy theories, and for some, it was financial devastation. But what really caused it? Why did the world's most famous cryptocurrency plummet so hard, so fast? Was it manipulation, regulation, or the bursting of a long overdue bubble? In this video, we're cutting through the hype, the memes, and the panic. We're going to break down exactly what happened during the Bitcoin crash, from the financial dominoes leading up to it, to the real forces behind the scenes. If you've ever held crypto, wanted to invest, or just want to understand why Bitcoin tanked so dramatically, this is the full story. Let's get right into it. The rise before the fall. Before we talk crash, we have to talk about the climb. In late 2020 through 2021, Bitcoin was unstoppable. What began as a fringe digital currency exploded into the mainstream. Prices surged from $10,000 to nearly $69,000 in just over a year. Institutions like Tesla and MicroStrategy were buying in. Celebrities were tweeting about it. Even countries like El Salvador began adopting Bitcoin as legal tender. This wasn't just hype, it was a frenzy. Retail investors poured in, often driven by fear of missing out. People who had never bought stocks before were suddenly crypto experts. Bitcoin was on the news, in TV shows, and even showing up in Super Bowl ads. But here's the thing about rockets: the higher they fly, the harder they crash. Warning signs ignored. Even during the bull run, there were cracks. Bitcoin's volatility never went away. One tweet from Elon Musk could swing the market billions in either direction. Energy concerns about Bitcoin mining started drawing scrutiny. Countries like China began banning crypto transactions and mining. Despite the enthusiasm, the environment was fragile. And then came inflation. The US Federal Reserve signaled it would begin tightening monetary policy, raising interest rates to control inflation. That single move sent ripples across every asset class. Stocks dipped, bonds adjusted, and speculative assets like crypto, they got hit hardest. Still, many Bitcoin holders ignored the signs. After all, Bitcoin was supposed to be an inflation hedge, right? Wrong, at least not in this scenario. The 2022 crash begins. Now let's talk about the actual crash. In early 2022, Bitcoin began to tumble. From over $45,000 in January, it started slipping. Then the dam broke in May. The first major blow was the collapse of Terra USD, UST, and its sister token Luna. These were part of a popular DeFi ecosystem. When UST lost its dollar peg, the algorithm meant to stabilize it couldn't hold. Luna hyperinflated to try to compensate and lost nearly all its value. What does this have to do with Bitcoin? A lot. Luna Foundation Guard had purchased billions in Bitcoin to back their stablecoin. When UST failed, they were forced to dump their reserves, slamming the market with sell pressure. Bitcoin fell below $30,000, then $25,000, and just kept falling. The domino effect: Celsius, Voyager, and FTX. The crypto space isn't just Bitcoin. It's an interconnected web of platforms, tokens, lending services, and derivatives. When one piece collapses, the others follow. Soon after Terra's collapse, crypto lending platforms like Celsius and Voyager Digital began to wobble. They promised massive returns on user deposits, often using risky strategies. But once Bitcoin's value dropped and users rushed to withdraw funds, these platforms froze withdrawals. It got worse. Celsius filed for bankruptcy. Voyager followed, and then came the biggest bombshell: FTX. FTX was considered one of the safest, most professional crypto exchanges. Backed by celebrity endorsements and major investments, its founder Sam Bankman-Fried was seen as a genius. But behind the scenes, it was a mess. FTX was allegedly funneling customer funds into its trading firm, Alameda Research. When the news broke in Binance, a rival exchange, hinted at dumping FTX token, FTT, a full-blown bank run began. FTX collapsed in days. Billions vanished. Bitcoin was dragged down even further, not just by selling pressure, but by the sheer loss of trust. Panic selling and the human factor. During every crash, there's a moment when logic disappears. It becomes emotional. As the headlines turned apocalyptic and exchanges froze withdrawals, everyday investors panicked. Many were over-leveraged, trading Bitcoin on margin with borrowed money. When prices fell, they were liquidated automatically. Sell orders triggered more sell orders and prices cascaded downward. This is the human side of the crash. Fear, greed, and herd behavior created a perfect storm. Even people who had no direct exposure to Terra, Celsius, or FTX began pulling their money out of fear they'd be next. Bitcoin plunged below $20,000, then touched $16,000, the lowest it had been in years. Regulation cracks down. Once the dust began to settle, the regulators showed up. Governments and financial watchdogs had been slow to regulate crypto. But the crash, and especially the FTX scandal, was a wake-up call. U.S. Congress began holding hearings. The SEC started probing into multiple crypto firms. New rules were proposed for stablecoins, lending platforms, and crypto exchanges. The message was clear: crypto was no longer the Wild West. And while some viewed this as a death blow to decentralization, others saw it as necessary for crypto's survival. Regulation, they argued, could bring clarity and protect retail investors from future disasters. What was the real cause? So what really caused the crash? It wasn't one thing. It was a perfect storm of overvaluation, poor risk management, fragile economic conditions, and human psychology. Let's break it down. Over-leveraged platforms make huge bets with customer funds. Stablecoins collapse due to flawed algorithms. Major players dumped their Bitcoin reserves to cover losses. Global macroeconomic tightening spooked investors. Lack of regulation allowed risky behavior to go unchecked. Panic and herd behavior amplified the damage. Bitcoin didn't fail as a technology. The network still worked. Blocks were still mined. But the markets surrounding it, built on hype, leverage, and unchecked ambition, imploded. Is Bitcoin dead? Here's the million-dollar question: is Bitcoin dead? The answer is no, but it has changed. Every Bitcoin crash, and there have been several, is followed by obituaries, articles saying it's over, and people swearing off crypto forever. But Bitcoin has always been cyclical. Booms, busts, recovery, repeat. What's different now is the maturity of the space. Institutional investors, regulatory frameworks, and global adoption are no longer theoretical. They're real. Even after the crash, major financial firms continued to explore crypto products. Countries continued exploring central bank digital currencies. Bitcoin isn't dead, but it's no longer the wild, untouchable golden child. It's being forced to grow up. What should you do now? So what should you take from this? Whether you're holding crypto, thinking about it, or just watching from the sidelines, here's what the Bitcoin crash taught us. Always do your own research. Don't trust influencers, trends, or memes. Don't invest money you can't afford to lose. Understand the technology, not just the price. Be cautious of platforms offering unrealistic returns. Self-custody your assets, not your keys, not your coins. Bitcoin may still be part of the future, but that future will be slower, more regulated, and more grounded in reality, which honestly might be a good thing. So now you know what really happened during the Bitcoin crash. It wasn't a single villain. It was a combination of greed, bad code, risky bets, and a market that got too hot too fast. But understanding it gives you power. Power to make smarter decisions, to avoid falling into the same traps, to actually grasp how this technology works and how it sometimes fails. If you found this breakdown helpful, hit that like button, subscribe for more deep dive tech and finance content, and tell us in the comments, did you get burned in the crash or did you ride it out? And remember, markets move fast, but knowledge lasts. Stay sharp, stay skeptical, and stay curious.